We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Gareth Soloway, President and CFO of InTheMoneyStocks.com. Thanks for joining me today, Gareth.
Oh, Tom, always a pleasure to chat with you.
Absolutely. Feelings mutual. So Gareth, going back through an older video of yours, you pointed out that at the beginning of a bear market, capital rotates and tries to find a place to hide before it is removed completely. So in the example you had brought up, the S&P had peaked, months before oil did. So do you think that could be the case here of, seeing the S&P break that upward channel that you and I have talked about many times on the show? And really that combined with the Fed raising maybe too far with the use of lagging indicators?
Yeah. So I think that's exactly it, right? So it's important to remember that funds, hedge funds and big funds out there, we always think of them, they're institutions, they're ahead of the crowd, but a lot of them have to be chasers as well because they have to show their clients that they're in the hot thing. So we know that the tech stocks topped out kind of late last year, early this year. And then there was this massive rotation into oil. Oil was the new thing to be in. All the analysts, all the talking heads were all about, oil, that's going to be the safe place to be. Oil is going to go to $150 to $200 a barrel. And I came out and said to you guys out there, I said, be very careful here. Oil's probably topped at 130 when Russia invaded, and you're going to see downside. And I think today we saw a flush below $100 a barrel, almost 10% drop in oil. And it's important to recognize you had quarter end, right? So at the end of a quarter, all the big funds, they want to send those statements out to their clients and show, hey, we were in Exxon for the quarter, we were in oil, we were in copper, we were in all these other things. And then at the new quarter, they say to themselves, okay, we got to get out of this stuff now because it's way too overdone. With a recession potentially coming, these things could crash. And so you see this kind of action where they all run for the exits at once, and we get these massive down moves at the starts of these quarters.
So, Gareth, do you think that there's that really affects other commodities other than oil? Or is that action of capital just trying to find another place to go really over, do you think?
Yeah, so I think at least in a market like this that we're in, where it's not all, oh my goodness, we're going to go into a Great Depression. We're not at that point yet. Then funds are always looking for, okay, where can we rotate money to get exposure and potential profits, right? So initially it was tech stocks, then it rotated into ag stocks and oil stocks, and we saw those doing well. Now, if you've noticed, we've seen this kind of rollover in oil and ag stocks, and now it's back to tech stocks. Tech stocks had a great day today. We saw initially a gap lower in the markets, and then the NASDAQ stocks just started to rip higher. So we're seeing this money just rotate like round in a round circle, round and round. And that's the way it works in this kind of early to mid-cycle bear market. Now, we will eventually get to a point late in the cycle where it's sell everything, where total panic comes out, but we're not at that point. And remember, funds, big money, always needs to try to be invested because they're worried if they're not invested, their clients are going to find someone who does invest all of the money to get that return. I'm a big believer that sometimes being in cash is the best thing to do. We've seen the dollar have so much strength recently. It's actually been a great trade to be in cash. But you have to understand from a portfolio manager's perspective, they've always got to try to be in something.
Mm. So how do you see that cycle playing out? And where do you think the bottoming or the catalysts for a bottoming would occur?
Yeah, so I think for a bottom, at least in the overall stock market, right? And we could talk about crypto. This is going to apply to crypto. It kind of applies to everything. Mm-hmm. Is that you go through those stages of grief, right? And it's very applicable. So initially there's denial, and then you finally go down until you get to acceptance. And when you get to acceptance, that's when the bottom will be put in. And again, we're not there yet, not on the stock market, unfortunately not in crypto, although I do think crypto is closer to that than the stock market in terms of how much decline we've seen in Bitcoin and other altcoins. So I do think we're getting there, but it's not quite there yet. You will know when there's like, you hear blood in the streets. That will be the case, not literal blood in the streets, but it's more like everyone is just so upset and so frustrated with the markets and basically throws their hands up in the air and says, I don't even want to look at the stock market anymore. that's when you put in a bottom.
Mm-hmm. So, exactly as you're saying, Gareth, you have called for, and you were kind of famous for calling for that $20,000 bottom in Bitcoin. And now we've seen it break, 19,000 even. So where could we see Bitcoin get to as it has really followed the NASDAQ and there's likely more air to come out of that market as well?
Yeah, so let's take a look at the chart here on Bitcoin and see what we have. So right now we're still hovering around that 2017 high. That was my original call, as you know, that we would that was at least my minimum target. We have achieved that on Bitcoin. So my guess is near term, and when I say near term, I'm talking the next 2 to 4 weeks. I think you probably see a bounce in Bitcoin at minimum back to 25,500, maybe as high as resistance here around 28.5. But I do still think there's more downside. One of the key factors that's bothered me about the crypto markets is that it's so representative and identical to the .coms. And you haven't seen that flush out. Amazon went from $112 down to $6 back then. That's a 95% decline. I'm not sure if Bitcoin will drop that much, but I think you got to at least do your 80 to 85% that a normal bear cycle in Bitcoin does. And you also have to wipe out more coins. All right, there are way too many. There's still like tens of thousands of coins out there, even after Terra Luna kind of blew up. We've seen Celsius, which again, that's had a lot of problems. That's the beginning stages of what the .com bubble went through to bottom, but you have to see more of that. Mm-hmm. To me, that means that we haven't bottomed yet. We'll get a short-term bounce, and then my next downside target is 12 to 13,000.
So, how do you pick that target, Gareth, of 12 to 13,000?
That's a great question, right? So it's usually technicals. That's how I come up with these targets. So number one, if we look at the chart here, we can clearly see that after the 2017 high, and by the way, one of the things that makes me think the 2017 high is not the bottom is that almost everyone is saying it's the bottom, right? I mean, as we got closer, I was calling the 20,000 correction back when we were 60, 68,000. Mm-hmm. But then as we got to like 30, I started seeing it everywhere. Oh, we're going to 2017 highs. This is where we're going to bottom out. This will be the greatest buying opportunity. When everyone's saying something, it almost is never the case, right? So that alone is making me think it's going lower. And then we can look at this area here, right? There's just a ton of major support between 13 and 12,000. So that's part of it. And then let me show you this. This is a really cool tactic in technical analysis. It's called a measured move. So if we take this high to this low, which was basically a straight fall down, we then had this consolidation, right? So you had about 3 months of a parallel consolidation. And then basically from this high, if you take the same distance as that first move and we drop it down, you basically get 12,000. So this distance with this distance is identical. And that gives me also a calculated target to 12 to 13,000. Now, it doesn't guarantee Bitcoin will stop there, but it gives me a good multi-factor analysis technique to think that that could be a level where it has a chance to fully bottom out.
Mm-hmm. So I've seen that you initiated buying 1/6 of your hodling Bitcoin position at 19,000. So can you explain your strategy to us here? Do you really start getting into this position in staggered tranches so that you don't miss, having that position if it does turn around unexpectedly?
That's exactly what it is. So, my first target was 20,000. I made a commitment to myself to not buy until we at least pierced it. But at the same time, no trader knows the future. No trader is always going to be right 100% of the time. I certainly am not. So what I understand is that historically, if I slowly accumulate, overall, I gain exposure if it doesn't get down to, let's say, 12,000. Mm-hmm. But also by dollar cost averaging in, if it does go there, then maybe my average is around 15,000. And when it runs back to 60 to 65 or 70 or 100, I'm in a great position at that point. So it's a way to kind of understand and be humble enough. And God knows I've been humbled by the market so many times in my career. It's to understand that you're never going to be always right. So why even mess with it? Why even say, oh, well, I'll only buy at 12,000. Let me start at 19,000, 1/6 position. Every 2 to 3,000, I'll buy another 1/6. That even allows for me to buy below 12, back into the sub 10,000 range. Mm-hmm. And that's what I want to do. I'm not trying to pick an exact bottom. I'm just trying to put myself in a longer term position for big gains when we do get the turnaround.
And again, that's really different thinking and a different strategy than just putting on a trade, right?
Yeah. And that's so key, is like in my early career, and I think this is something that all new investors and traders struggle with, is they always go into a trade saying, I'm going to be right here. This is a support level. So because I think I'm going to be right, I'm going to bet the farm, right? Or put my, full account in. And I've learned, unfortunately, many times in my earlier career, is that that's how you take big losses. And then you end up down 25, 30%, and you're struggling just to get back to break even. So I've mitigated that strategy by implementing this new strategy, which helps me always participate, but gets me the lowest dollar cost average possible.
And again, with a specific timeline, which is a longer timeline in mind, right?
Yeah. So I'll always be swing trading Bitcoin. I'll be in, I'll be out, I'll be in, I'll be out. But I because I'm a long-term bull that really sees a place in society, in the global society for Bitcoin, it makes me want to have some that I'm going to basically hodl, as the term is. And that's why I'm starting to accumulate sub 20,000.
Mm-hmm. So Gareth, considering, the age-old saying of don't fight the Fed, I think there's been a lot of speculators here that have learned that lesson and really how dependent on the liquidity that the Fed has given the markets, how dependent the markets really are on that. So what do you think causes the Fed to pivot here? How do they continue to fight inflation if, for example, unemployment, really starts to get bad?
Yeah. So what you said is so important too, is that the thesis before the end of 2021, before the Fed started pulling back on their printing, it was don't fight the Fed, which was correct. But one of the things that we find out about human nature, and this is the psychology of an investor, is that once the thesis changes and goes against what you want to do, you kind of change your thinking. And you can't do that in trading, just like in life. You have to say, okay, well, the Fed is telling us they're pulling back on all this money printing. So really, don't fight the Fed means get the heck out of the markets or go short the markets. But people are so conditioned to say, well, I just want to make money. So I'm going to say, well, it doesn't matter now what the Fed says. I'm going to just go along anyways, or I'm going to buy the dips anyways because it worked. But we really have to take the cues from what the Federal Reserve has said and abide by them. So that's a good point there that you make. And then what was your second part of that question?
Well, what causes them to actually pivot or become more dovish if they see unemployment really start to rise?
Yeah, so I think this is the key, is that number one, we have to see inflation come down. And so the fact that oil dropped, oil just like 2 weeks ago was north of $120 a barrel. I think it closed today right around or just sub 100. That if that continues, number one, just that drop alone will bring down inflation a little bit in the near term. But I think at least for me, I'm expecting oil to come back to 85 to 75 by the midterm. So that is going to bring in inflation, which will take some pressure off the Federal Reserve from continually hiking rates. Now, the key is going to be this. If you're going to basically get a scale, right? So here's a scale. On one side, we have unemployment. On the other side, inflation. Now, right now, inflation's up here. Unemployment's way down here. Now, as we see inflation come down, but the economy start to get into recession, you're going to see unemployment rise. Once unemployment is above inflation, that's going to be the greater evil for the Federal Reserve. So they're going to have to attack that by lowering rates and printing money. And what that's going to do is then it's going to push unemployment down, but then inflation is going to rise, right? And so now they have to attack this one, and back and forth and back and forth. Ultimately, each one is going to go slowly higher and higher, though, which is the end game, unfortunately, for the system. And I think, again, by the end of this decade, we're probably close to a depression type scenario. And I don't mean to be all doom and gloom, because if you're a trader, if you're an investor, there's going to be so many opportunities. But I do think the Fed is going to play whack-a-mole with one or the other going forward, and that's going to be a tough scenario for the markets and for citizens in general with inflation.
Mm-hmm. So all of those things that we just went over, all of that considered, Gareth, what is your outlook for inflation for the rest of the year? Do you see it backing off here, and then unemployment really becoming the focus of the Fed?
Yeah, I do. So I think that we've already seen a slowing in the economy. We've seen signals that the housing market is starting to cool rapidly because the 30-year has jumped so much. Interest rates are up so much. And I think just the cooling of the economy is going to bring down oil, right? If you have less people driving, less people flying because they don't have as much money and the economy is getting slower, then inevitably it's going to bring down oil prices. It's going to bring down commodities as a whole, which we've already seen starting to collapse here. Massive drops in copper, massive drops in platinum. And we've also seen oil collapse here as well. So all of that is going to bring the CPI numbers down over the next few months. the Fed is probably going to claim victory, but they're going to prematurely do that, I think. And ultimately, we'll see the economy slipping more and more towards recession by end of year, early 2023. And then you're going to be in this position where the Fed has to say, okay, well, we can't let this recession turn into a depression. So now we need to start the printing presses up again and stimulate either by cutting rates or actually printing money directly.
Bonds have always been said to be a very safe and stable place to be. So how do the bonds fit into people's thinking here as well?
Yeah, and to talk about stability, that certainly isn't something that we refer to the bond market with these days. Isn't that crazy? I mean, the volatility has been unprecedented in the bond market with these type of moves. Historically, this does not happen. It tells you that the markets are dealing with something major here. Now, I will say this is that I was calling for a pullback when we got to this 3.4% on the 10-year. Let me just show you why. I think this is a really key chart to understand. This is, by the way, this is how powerful charts are, because when we were at 3.4% on the 10-year, there were people that were saying, oh my goodness, this is getting out of control. They were fretting that bullish kind of, rates are going to go up to 4 or 5%. But if you looked at the chart, there was this amazing trend line that connecting the recent highs going back to 2013, it's a perfect trend line, right? And so sure enough, we hit, and now we're pulling back on rates. So it's almost as if the bond market is already anticipating that the Fed is going to slow their hiking of interest rates and maybe even reverse by end of year, early next year. So I think that's fascinating to look how the charts kind of predicted this rollover in rates. And again, it's just the power of the chart. So I would always say to people, it's easy to pay attention to what the talking heads are doing and the panic and the fear and the Twitter sphere and all that stuff. But the charts are your purest form of truth. They really are.
Mm-hmm. And again, I mean, we've heard that the bond markets are some of the smartest markets in the world. So taking that lesson from them and trying to figure out what they're telegraphing is interesting there, right?
Yeah, absolutely. Absolutely. So you have to look at the bond market. It's known to be the smartest one. The size of the bond market is many times what the stock market is. So that's where the real money is. I know that's kind of, crazy to think, but I think that is important to remember.
Mm-hmm. So is the Fed funds rate really the only thing that keeps making the dollar stronger from here, Gareth?
Yeah, I think that the Fed funds rate, again, you have to think about the run to safety. So we're in a position now where the global market, I mean, the euro is just having so much trouble, which is adding strength to the dollar. But I do think we're also at an inflection point. The dollar, to me, is also at that point. And in fact, let me bring up a chart here of the US dollar. The US dollar has absolutely, been right at this longer term trend line right up here. So you can make a case that you're now hitting resistance on the US dollar, and the dollar is so short-term overbought. I mean, just from 2021, 1 year ago, we have had a massive move up in the dollar. So I'm in the camp that the dollar is actually going to pull back here. And I think that is going to be a follower of what the yields are doing. It tells you that the Fed may start printing money, but the dollar is a lagging indicator. I think the yield curve or the yield itself is a leading indicator. I do think the dollar pulls back pretty sharply here.
So even if it's let's say a safe haven demand asset, you still think there is downside possibility?
I do. Yeah, I'm in the camp where I think that relative to other currencies, remember that's kind of where the dollar is traded versus the euro versus the yen. I think that you're going to see that the European Union is going to start talking up, policies that will strengthen the euro. They're probably getting a little concerned about how weak it's gotten so quickly. The same thing with some of these other currencies out there. And I do think that the thought process that the Fed will eventually start printing. Right now, no one's thinking that, right? So the dollar's remaining strong. Oh, Europe's in a tight spot. Maybe they'll have to print, but the dollar, the US is doing great. Well, as we get to end of year, I don't think that's going to be the view. And I think the view is, wait a minute. The Fed, we're now slipping into a recession. Could this be worse? Does the Fed need to print? Inflation is coming down. Those kind of thought processes will come out and bring the dollar back in a little bit.
Mm-hmm. When do you think the possibility of really that sea change of Europe not being able to strengthen the euro anymore? If they have to keep all these different bonds solvent, how do they continue having relative strength in the euro?
Yeah, I mean, that's a great question. And the thing is, you have to It's a tough scenario here to figure out how this is all going to play out. There are so many moving parts, but I would say that again, the European Union will do whatever they have to do to try to maintain the strength of their economy, or at least boost their economy back. And the reason I say that is because you don't just have a slowing economy, but you have the whole natural gas crisis over there. You have so many of these other factors out there that are now playing a role that are slowing the European economy. So I do think that they're going to have to come out and maybe do some stopgaps here, but don't be surprised if their next Fed meeting, the ECB meeting, does talk about ways to kind of stimulate.
Mm-hmm. Interesting.
Yeah, it's such an interesting time we're living in right now.
That is both a blessing and a curse, right, Gareth?
Yeah, exactly. It really is.
And as you say, there's so many different pieces, so many moving parts to this puzzle. That's why it makes it so hard to figure out, right?
So true. I mean, when you look at what the bond market's doing, the dollar, the European markets, I mean, everything, stock market, crypto market, everything is in turmoil right now. And it really is creating this unknown fear out there, which is valid. But again, usually fear yields opportunity. I always tell people that, always remember that when there's max fear and there's panic, then there's usually a great opportunity somewhere.
And yet that uncertainty also creates panic for the markets, right? Uncertainty is usually very negative.
Yes, absolutely. Markets do not like uncertainty. They like to know what's going on at all times. But during those uncertain times is where you get those crazy flushes where panic hits. And that's where you'll get these crazy opportunities on the long side. And I think that'll come for Bitcoin. Not quite there yet. I think a small bounce, but ultimately it will come for other things.
Mm-hmm. So does that rollover for the dollar start to act as a tailwind for gold again? How do you see gold, performing for the rest of the year?
That's exactly what I'm thinking is going to happen with gold. So gold, and let me bring up that chart for you guys. Gold had a nasty down day today because the dollar absolutely soared, but really it's right back to this longer term trend line right here. And the key here is that if you look at gold, I think it's flat to slightly maybe down like 1 or 2% for the year. But keep in mind, think about what the dollar has done. Usually when the dollar soars like it has, when you have this type of move up in the dollar from the start of the year, from here all the way up, gold should be down 10, 15, 20% on the year off of this move. And gold is basically flat. So that's a hugely bullish signal for me over the next 6 to 12 months for gold. And I really do think that, again, gold is setting up here to be kind of the comeback kid, if you will, and perform amazingly well in the second half and beyond.
Mm-hmm. So do you have a similar strategy in buying gold as you do with Bitcoin of buying in tranches?
Yeah, so exactly. It's really my strategy now for any time I'm swing trading or buying a longer term accumulation. It's making sure to understand that I can be wrong. A technical level, I mean, people think technical levels are levels made in rock that can't be broken, but I've learned that they can be broken. And so you have to prepare for that inevitable scenario. Sometimes they're not, in which case you have a small position, you make easy money. I always play for the harder scenario. I'd rather be defensive because, again, when you're dealing with a lot of money, you don't want to say bye-bye to that money too easily.
Well, even, I mean, whether it's a lot of money or not too much, either way, you don't want to lose it, right?
No, that's the key, right? Is that I think generally early on in someone's investing career, they think they have to make a ton of money very, very quickly. But the reality of it is slow and steady makes you way more money. Like one of the weird concepts about trading is that people think when they become a trader, they have to trade like 20 times a day to maximize money. I've made more money by trading once or twice a day than I ever did by trading way too many times. And the key there is understanding is that the best opportunities get you in trades that are easier to manage. You're in, you're out quickly. And when you get in too many trades, you're basically forcing trades. And that, again, is something that isn't necessarily a good thing to do. So trade less, make more, and understand, that's the mentality of a good investor and trader.
Excellent. The last time we spoke, we were just starting to talk about the conflict in Ukraine with Russia here. So how do you see the Russian ruble and the strength that it has really gained over the past couple months here? And anything around the Ukraine conflict that you think is worth mentioning here?
Yeah, so you're right about that. The ruble has just been incredible in terms of its recent move. I mean, soaring. My guess is that has a lot to do with the price of oil and the fact that we know now that Russia's still selling all their oil. It's just going to different countries that are willing to buy it at a discount. But I think that's fascinating what's gone on, and it is worth noting. The question also is the market factoring out a different outcome where Russia comes out stronger from this conflict? And again, we don't know this. It's trying to read the tea leaves, aka the charts, and say, okay, well, what does this mean? Because obviously the idea was that if we put all these sanctions on and everything like that, then their economy collapses. But certainly the ruble strengthening like it has is not doing that.
Excellent, Gareth. I think that's a pretty good place to wrap up for today. Was there any other charts you wanted to go through?
No, I think that's perfect. I think again, we should definitely get on once a month at least and talk charts. I love chatting with you. But again, I think that investors just have to remember it's a bear market in almost every asset. You could argue that oil and commodities weren't, but I think that they are entering one. If you go to 2008, oil did the same thing. Markets topped out in late 07. Oil ran up into 08 all the way to $140 and then collapsed very quick. So looking at charts gives you a beautiful insight into what's going on here.
Absolutely. And I can put a link to that video. It's an interesting lesson. And of course, history doesn't always repeat, but it does often rhyme. So that's an interesting perspective to add to our toolkit there.
Yeah, absolutely.
Gareth, thanks so much for your time today. Of course, you're available at InTheMoneyStocks.com. Anywhere else you want to point to?
For crypto, verifiedinvestingcrypto.com. But those are my main two spots. And thank you for letting me mention them.
Of course. Thanks so much, Gareth.
Thank you.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.